There's several factors that are simultaneously coming together in the market. First, there's an appetite for risk. I don't think there's any doubt about it. When interest rates in the United States are close to zero, and when the Fed has signaled that they're likely to remain close to zero for a long period of time, and you've got very significant amounts of bonds trading at negative interest rates internationally, people in many ways are reaching for yield. They're looking for opportunities. They're looking for more attractive ways to put their money to work. And SPACs are a very interesting opportunity. At one level, they're an arbitrage opportunity for people trying to make a little bit of money on the side. If you can pick up 1, 2, 3% relatively risk-free in today's environment, that's a very nice trade for some people that play in the SPAC market. And then it's another way to get exposure to some early stage IPO-style returns with a much more significant degree of risk for other investors at a different stage in the SPAC life cycle.
But do we lose something in the regulatory oversight, or do you think it's just as good as an IPO or a direct listing, which are also getting quite popular right now?
I don't know that I'd use the phrase just as good. Instead, what I'd say, there are multiple differentiated ways of companies coming to the market now. As you properly pointed out, we've got the traditional firm commitment underwriting. We now have direct offerings. Those are, however, primarily done as secondaries. We don't yet have situations where companies themselves are doing direct offerings and coming to market. And then we have these SPAC transactions where, again, you're absolutely right. When you initially buy into the SPAC, you have no idea who the merger partner is going to be. You're instead betting on the founders of the SPAC and their ability to find a good merger partner, and more importantly, or just as importantly, negotiate a price that will be appealing to the investors.
For the reasons you described, this is very popular right now. A lot of people are doing it. It's almost an unlimited number of SPACs. At the same time, the track record, thus far at least, is not all that strong. I mean, if this were really, truly a better mousetrap in the longer term, then you'd think the value of these things would be going up. It's not consistently going up as they go public.
That's a hard measure, right? Because there's a lot of risk in many of these SPACs, and in situations where there's a lot of risk, what you expect to see is a lot of volatility. That's the definition of risk, and that's precisely what we're seeing. We're seeing some SPACs run up. We're seeing some SPACs not do as well. We're seeing situations where SPACs go public and there are questions about the integrity of the SPAC and the due diligence process that led to the transaction. But by the same token, you've got the same kind of issues in many traditional IPOs as well.
Who's making the most money off of these? Are they the people who put together the SPACs? How do they get paid, compensated?
Again, it's all over the map. There have been a number of situations where some early funders of SPACs, where the promoters of SPACs, have made a large amount of money by putting up a relatively small amount of money. And here in Silicon Valley, that's been pretty remarkable. Because if you stop and if you think about Silicon Valley, if you fund a company in Series A, and if the plan is to take it public, you're typically in today's world talking about a 10 to 12-year life cycle. So you have to be a patient investor. It's not quick money out here in Silicon Valley. It's patient money, it's hard work, it's a lot of risk. Now, if you sponsor a SPAC, and if you wind up doing a good deal, you can make 100x on the amount of money that you put in, and you walk away with it in less than 2 years. So, and that, by the way, is one of the reasons why we see so many SPACs coming to market. There's an option-like structure here, and what you've got is a lot of, well-capitalized, high-net-worth individuals who say, look, I'm going to buy the equivalent of a call option. If it works, great. If it doesn't work, all right, what have I lost? A few $1 million.
Thus far, it's been very sophisticated investors, institutional investors, and hedge funds that have principally been investing in these. But now we have an ETF. What happens when the retail investor can participate in this? Is that a good thing?
Well, I think the phenomenon is a little bit different. It's not that it's moving to the retail investor, it's the demand-supply equilibrium. You have a look at the number of SPACs that exist, then you have a look at the number of companies that are really at a point in their growth cycle where it makes sense to go public through a SPAC. And I think we are at a point where we've got more supply of SPACs than we do of companies that really would rationally merge into them, which in a sense, given the leverage that's available to the promoters, is something that I wouldn't entirely expect in this environment.